Welcome to The Long and the Short, a show where you can expect an honest take on trading, something you won't hear elsewhere. I'm your host, Sandeep Rao. Today we are going to talk about a topic that fascinates many beginner traders, especially intraday traders, and that is scalping. As an idea, scalping is incredibly tempting. After all, who wouldn't be interested in making money quickly, and if possible, multiple times in a day? But the fact is, beyond that temptation, almost everything about scalping is extremely difficult. I haven't seen many traders sustain it over the long run. Whether they started out making money or losing it doesn't really matter. But very few are able to do it for years together. So as with all other topics we cover on this show, in this episode as well, we will look at scalping through an objective, rules-based lens. May not be fully systematic, but data-informed for sure. By looking at the data, we'll try to understand whether there are any real opportunities in liquid underlyings like Nifty and where those opportunities might exist, and how we can go about identifying them. So without further ado, let's get started. Disclaimers first. The ideas and examples shared in this episode are strictly for educational and illustrative purposes only. Nothing discussed here should be construed as a recommendation, investment advice, or a solicitation to trade. Trading in derivatives involves significant risk and can result in complete loss of capital. The examples and data presented are meant to explain market behavior, not to suggest that similar outcomes will occur in the future. Also, a basic understanding of options and derivatives is assumed to fully understand the concepts discussed in this episode. So with the disclaimers done, let's get started. You see, the CME Group, which is the Chicago Mercantile Exchange, defines scalping as to trade for small gains. Scalping normally involves establishing and liquidating a position quickly, usually within seconds. And a scalper, according to them, is a speculator on an exchange floor who trades in and out of the market on very small price fluctuations. The scalper trading in this manner provides market liquidity but seldom carries a position overnight. If you observe the way they define scalping, this method originated from the trading pits where floor traders had relatively low commissions to pay. Traders would make buy and sell trades to make quick profits. Long back, I went into this rabbit hole to understand how floor traders really traded. And that led me to this book aptly titled The Traders by Sonny Kleinfeld. The book is set in early 1980s and follows the lives and careers of 5 successful floor traders across different exchanges in the US. To give you a glimpse of how they would scalp, here's a small excerpt about a trader named Henner who traded British pound futures at CME. Henner races in and out of the ring. When he comes out and talks, one eye is always glued to the big electronic price board. When he spots something he likes, he politely excuses himself and darts into the pit. He comes out at 8:51. He furrows his brow and a bewildered expression plays across his face. I went in there and lost $500 right away, he says in a chipper tone. Then I came back. I'm up about $100 right now. To me, it was a crazy fascinating book. It gave me a close glimpse of what it was like being a trader on the floor. Talking about scalping, a few years later, sometime from 1998 to 1993, was the SOES Bandit era, where traders would execute hundreds of trades in NASDAQ stocks. These trades were nothing but order flow based scalping. Order flow simply means watching the actual buying and selling happening in the market in real time. Just like we have market depth window on Kite where you see bids and offers live during market hours. Like that, order flow traders watch bids, asks, and incoming orders to judge whether buyers or sellers are gaining control and then scalp small moves based on that. If you want to read about that era and what was happening during that time, you may want to read the book Secrets of the SOES Bandits. The original electronic trader reveals his battle-tested trading techniques, authored by none other than Harvey Houtkin himself, the man who was a pioneer in many ways. Closer home, even in India, we had scalpers or market makers on BSE. They were called jobbers. After NSE came in with electronic order book, many jobbers became dealers and some left the industry. But that doesn't mean the idea of short-term trading died. With the emergence of discount broking and derivatives like options, short-term trading made a comeback, and this time it wasn't just the institutions that were trading. Even retail traders saw an opportunity in it. Today, thanks to technology and multiple trading tools that are available to retail, scalping becomes even more accessible. But accessible does not necessarily mean easy. So we now have some sense of what scalping actually means. But how do we get started with it? What kind of knowledge and skills are key? And lastly, are there any trading frameworks that can help scalp better? As we move forward, those are the questions that I would spend my time on. So, how do we get started with scalping? You will obviously need a broking account with access to derivatives or F&O. Next, you need to have a basic understanding of how options work. The reason we focus on index options is because it's highly liquid and offers the lowest break-even costs. To give you an example of the break-even costs on Nifty options, while the costs have gone up considerably over the years, but it's still around 1 point for options. That means if you buy a Nifty option worth 200 with a lot size of 65 and sell it at 202, you will still be in green. And that's the worst case break-even cost. However, for a freeze quantity of 1755, it drops down to 0.4 points. With the basics sorted, we will now move to more important things. Because having a broking account and knowing options is not going to help you get better at scalping. Now, since scalping is all about intraday trading, you would need to understand what I would call the intraday market structure. Now, the obvious question is, what is intraday market structure after all? You see, every day market opens at 9:15. Yes, there is a pre-open before that, but you cannot trade at that time, so it's only at 9:15 when you can place your first trade if you want. The market closes at 3:30. So the market remains open for trading for 6 hours 15 minutes, which is 375 minutes. When we talk about intraday market structure, we are talking about understanding a few things about the specific market or index that you would want to trade. The key is to get a handle on intraday market statistics for that index, which include things like range, which is how much does the index move between open and close. Say if we divide the market into 3 equal time windows of 125 minutes each. What percentage of range does the market make in each of the windows? Next, what if you fix 1 hour range of 9:15 to 10:15 and the market breaks out of it? What are the odds of it holding above it? How often does the market trend and how often does it mean revert? What does trend even mean on an intraday time frame? What happens to the range after a big gap up or gap down? What happens when price reaches important levels like round numbers, previous day close or previous day high, low, or maybe the all-time high? Likewise, any day of the week effects. Does Friday have a high range usually? Stuff like this. Understanding intraday market structure includes all of this and more. In essence, we are trying to add some context and measures to what the market does during the day. This context and set of measures helps us build rules for entries and exits. In short, think of intraday market metrics as a map. Not sure if you've heard of this profound phrase by Alfred Korzybski, map is not the territory. What that means is while maps give you a sense of what is there, it is not and cannot be a perfect representation of reality. Same is true with market statistics. It gives you a sense of what happens during the day, but what happens in reality is always a bit different from what statistics say. There are more layers to reality which statistics unfortunately cannot reveal. Once you have an understanding of the index behavior, the next is to build an understanding of the product that you would be using to trade. Yes, you have to trade a levered product like futures or options, and between both, as we speak, it's options that wins hands down. If you're new to the concept of what is leverage, watch this video. You need a product that is liquid and costless transaction cost wise. Again, index options especially wins hands down over here. Since we are trading options, it brings with it some obvious challenges, and that's why knowledge of how options work, including Greeks, is important. In an ideal world, product-wise, you would need an index that moves fast enough for scalping, like Bank Nifty in the earlier days with weekly expiry, or currently Sensex where intraday momentum is much sharper. However, if you are looking for liquidity and scale with slightly muted volatility, Nifty also works pretty well. Next, you have to choose if you would like to scalp as a seller or as a buyer. That decision itself can change the odds of winning big time. Now, since we're talking options, you have to get your strike selection right. DT wise, expiry selection, all of that. In a sense, it's better if you have clear thumb rules for each of these so that you don't want to be struggling with strike selection when scalping. So far, we have spoken about market structure statistics, product knowledge. Next is understanding the idea or the concept of expectancy. At the end of the day, you may take 10 trades a day or 100. What matters is, are you net, that is net of costs, making money? Expectancy measures just that. What is the average profit you make per trade after including loss-making trades? Let's take an example. Let's say you take 10 trades all starting with 100. You win 5 times and you lose 5 times. So your win rate is 50%. Now in this example, if you take the total of the profitable trades, it's 110. And the total of the loss-making trades is 50. So the average win is 110 divided by 5, that is 22. And the average loss is 50 divided by 5, which is 10. Now let's apply the expectancy formula. E, which is expectancy, is equal to probability of win multiplied by average win minus probability of loss multiplied by average loss. So that's 0.5 into 22 minus 0.5 into 10, and that comes to 6. In our example, the expectancy is 6, which means for every trade we took, we made an average of 6 points. This positive number indicates a profitable system overall. But there's another practical aspect that matters a lot in trading, and it's often ignored, and that's the sequence of P&L. Even if the system has a positive expectancy of +6, the outcomes won't come in a smooth order. You could easily face 5 losses in a row before the winners show up. If your average loss is 10 points, that's a 50-point drawdown before the system starts paying out. This is why expectancy alone is not enough. Your psychology and risk management must be able to survive the sequence of losses. Otherwise, even a profitable system becomes impossible to trade. There is one more critical aspect hidden in this formula. You have 2 levers to play with: win rate and average win. So you either have to have a very high win rate or a very high average win to keep the overall system profitable. In scalping, you gotta have a high win rate usually. It's not some kind of a trend following system where you could settle with a 30 or a 40% win rate. High win rates are key because that's what would justify the effort and makes it easy psychologically. But high win rate also means occasional large losses, and managing that is key. So in a way, it comes down to solid risk management. There will be days when you are on a tilt and you need to stop on those days. Else, months worth of profits can go off in a single day. So far, we've spoken about market structure statistics, index or product knowledge, and expectancy, and things which expectancy doesn't tell you. Now here's the last and perhaps equally important part: creating a broad system and rule set for entries and exits using indicators. Now do note, the kind of scalping that we are going to talk about is going to be discretionary, but at the same time it'll be data informed. Now it has to be data informed because we will be using market structure stats to trade based on it. And we would also need to keep an eye on some of those statistics live during market hours. The only way to do that is to have specific indicators that would give you that data. And if I had to think about it, you would need two categories of indicators. One set for market structure and one set for the index trend. Market structure related indicators would tell you about what's happening in the index, how much more meat is left in the move, and are the odds in your favor on a given day for a given setup. And the trend indicators are obviously for determining the direction of the move. To give you an example of a market structure related indicator, at any point in time, you need to keep a track of the high-low range. You cannot be calculating it live. It's better to have an indicator that tells you that. Likewise, you also need to know range as a percentage of the daily average range. That can be, for example, 5-day average range. But it's a good indicator of what has happened during the day with respect to what usually happens in the past 5 days. Next, you will need a couple of indicators for the intraday trend. For instance, TWAP is one such indicator. Now, since we are talking about spot, VWAP won't work on spot, and therefore we are replacing it with what is known as TWAP. Now, if you ask me what is TWAP, well, TWAP stands for time weighted average price. It is the average price of an instrument over a period of time calculated by giving equal weight to prices at each time interval. It helps show the intraday average price trend without being influenced by any kind of volume spikes. When price stays above TWAP, it generally indicates intraday strength. When it stays below TWAP, it indicates weakness. Since VWAP requires volume data, TWAP becomes a simple alternative when trading the spot index where volume data may not be available. Next, you need a couple of more indicators to give you a precise idea of the trend and the trend changes. A smoothened Heikin-Ashi is one of them. Some like using moving averages, and that's fine too. Last and perhaps equally more important is keeping a track of your performance. In this day and age of LLMs, it's super easy. You can either upload your order book daily and ask for statistics, or you can check the next day through console. And that brings us to the end of this episode 1 on scalping. In the next episode, we will go deep into what market structure statistics we should be looking at and subsequently how to determine entries and exits for the trades. I hope you found this episode useful and interesting. Do share your questions, thoughts, and feedback in the comments. I will do my best to respond. Thank you for watching and see you in the next one.